Hello there, welcome to another live webinar. This is Sri, your facilitator of the day, and welcome to another Phillip Nova webinar. What will we be discussing today? Singapore REIT sectors rotation. How interesting is that? And what are the risks and opportunities with REIT sectors rotation? And with us in the studio, we have Mr. Kenny Low, Wealth Advisory Director, and also SGX Academy REIT Trainer. So you're in very good hands today. Kenny is a Wealth Advisory Director, as I mentioned earlier, and a REIT specialist of Singapore's top independent financial advisor. He helps clients construct diversified portfolios consisting of different asset classes from REITs, equities, bonds, ETFs, unit trusts, private equity, alternative investments, digital assets, fixed maturity funds to achieve an optimal risk-adjusted return. Kenny is also a certified financial planner, SGX Academy REIT Trainer, certified IBF Trainer of Associate REIT Investment Advisor, ARIA, and also an invited speaker of Money FM, uh, along with the REIT Symposium and Invest Fair. You probably heard from him over the weekend if you attended Invest Fair. And what will we be covering today with regards to Singapore REIT sectors rotations, along with what are the risks as well as opportunities? We will explore potential rewards and challenges associated with sector rotation within the REIT market in Singapore. Kenny will dissect market trends, macroeconomic factors, sector-specific risks to help you make informed decisions, then how to capitalize on shifting market dynamics, identify sectors with growth potential, and effectively manage risk. Whether you're a seasoned investor or new to REITs, this webinar will equip you with valuable insights to navigate sector rotations in Singapore REITs confidence. And before I hand the time over to Kenny, I'm just going to do a very short poll. Can you hear me loud and clear?
Yes, I can hear you.
All right, great. Thanks for the confirmation from Kenny. All right. Okay, I'm just going to hand time over to Kenny now. Kenny, I'm going to give you sharing rights, so you should see a prompt on your screen very shortly.
Okay, are you able to see my screen?
Nope. I'm thinking it's still low. Do you see a prompt on the screen? I don't see a screen.
I have shared my screen. Are you able to load my screen?
No. Okay, let me try that again. Okay, I'm gonna give myself sharing rights first. Share my screen. Okay, and then I'm gonna give you sharing rights right now. You should see a prompt on your screen.
Okay, so which button should I choose?
Show. Yes, correct. All right, great. Your slides have loaded. The floor is yours, Kenny.
All right. Okay. Thank you. Very good evening to everyone. I hope all of you have already have your dinner. If not, maybe we just can listen to this webinar at the same time have your dinner. So today's topic, I will be sharing about the REIT sector rotation. What are the risks and opportunity? So disclaimer first. Let me see. Okay, disclaimer. I will share some of the REIT information over there and some of the financial ratio. And some of the REIT based on the valuation itself, it looks very attractive. But just to take note that those are not a buy and sell recommendation, although I am the licensed financial advisor, because there are some of the any investment decision, you need to look at your total financial situation and also total investment portfolio as a whole when it comes to the investment decision. So about myself, beside what the introduction just now, I'm the Wealth Advisory Director and also the REIT Specialist for of one of the Singapore largest independent financial advisory firm. And at the same time, I'm also the SGX Trainer and also IBF Trainer. This morning, I just have the market update on the Money FM 89.3. If they already uploaded on the Money FM, if you want to understand more about the REIT sector when we come to the internalization for the Savannah REIT, you can listen to that to this morning episode. And I have two websites. One is my blog, My Stock Investing. The other one is a REIT Trainer, REIT Savvy. You can go there, and some of the information actually I extracted from REIT Savvy for presentation purpose. So today content, typical 5 agenda. I will give an overview of a Singapore REITs, and also I will touch a little bit on the macro. What is the interest rate movement moving forward, and how it can impact the REITs. And I will do some introduction, what are the typical REIT sector in Singapore, and also the sector performance until today, and also the valuation for each of the sector. And lastly, I will wrap it up with what the investor can do for a second half of this year and also beyond moving forward. Overview of Singapore REIT. All in all, Singapore has about 38 REIT and also 4 business trusts. So combined together, we have a 42 REIT and property trust with a market capitalization of close to 100 billion. At the present moment, the average dividend yield is 8.1%, which is pretty high, much more higher than our treasury bill, or around 3.something%. And in terms of the price to book, this one is to measure the valuation. Okay, so in short, anything less than 1 is undervalued. At the present moment, the Singapore REIT sector as a whole is traded at 25% discount to the fair value. Okay, because when it comes to the REIT investment, we are talking about the real estate investment. Of course, we want to look for some good property selling at a huge discount. Okay, and over the long term wise, 10 years market capitalization, it has been growing year over year at a CAGR of 7%. And although the REIT is listed in Singapore, it does not mean that all the property actually in Singapore. If you look at the pie chart here, out of the 40 over REITs here, right? So only three of them has 100% of the property in Singapore. Only 3. And 17 of them have 100% of the overseas property. They are not in Singapore, it's overseas. It can be scattered around the world, in US, in Europe, in UK, Japan, China, and so on and so forth. And 20 of them has a combination of a Singapore and also overseas property. And all this property has diversification into a different sector. For example, industrial sector, hospitality sector, diversified REIT, retail REIT, office REIT, specialized REIT, and also healthcare REIT. So in short, that by investing in Singapore REIT, investors have the opportunity to really diversify your investment around the world. You do not need to go to other country to buy the physical property itself. Basically, we just sit in front of a computer and have a trading platform, and you are able to really have an exposure into the overseas property. At the present moment, Singapore REIT, compared to other asset class, Singapore REIT has one of the highest yield. If you compare to the bank saving of 0.05%, is a POSB saving, and the 12 months fixed 3.2%, 1 year treasury bill, 5-year government bonds, so on, and all these things is around 3% level. And by investing in other asset class, for example, 1 year, 5 year, 10 year Singapore SSP, we are not able to really beat the inflation. If you are not able to beat inflation from the return, over the long term, our purchasing power will be eroded. So as an investor, we always look for opportunity on the asset class which are able to generate the return to beat the inflation. So REIT can be one of the asset class an investor can pay attention to. Okay, this is a pro and cons of the yield income asset class. I'm not going through the whole table itself. I just want to highlight some of the key things, that because I believe that most of the investors at the present moment are holding or having a cash or park your cash under the T-bill. All right, so I just quickly do a comparison between the T-bill and also the REIT itself. So T-bill, basically the interest payout is fixed, and also the duration is only 6 months to 1 year. Every 6 months or every 1 year, if you really want to renew your or T-bill itself, you have to do it every now and then. The yield is pretty low over the long term. At the present moment, of course, it's high. But if you look at the historical data, later I will show you the T-bill is not as at the present moment is a so-called historical high. There's no growth in potential in terms of capital. Of course, the good thing about T-bill is there's no price or volatility. And every time when your T-bill matured, you take back a whole capital and you have to look for some other thing to reinvest again. Okay, management, you need to do some management to roll over your T-bill. For REIT itself, the income is not fixed. It very much depends on the dividend payout. If the REIT is doing well, they'll pay higher dividend. If the REIT is not doing well, they'll pay lower dividend. Okay, and the duration, basically, once you invest in REIT, you can more or less say that the whole your lifetime, you have a lifetime income, because the payout is regular, either payout every 3 months or every half a year, and this payout is perpetual as long as you do not liquidate your portfolio. And in terms of yield, moderate high, definitely higher than a T-bill. And over the long term, being the real estate and also the inflation, over the long term, you appreciate the real estate valuation. So investing in REIT, besides you getting the regular dividend, at the same time you also have some capital appreciation. Price volatility definitely is much more higher than T-bill. T-bill, there's no price movement, but a REIT, they are subject to market volatility. And one of the disadvantage of REIT is you need to actively manage the corporate action, because now and then they have a dividend reinvestment plan. You have a right issue and some of the EGM to make a decision. Okay, now I move into the sector comparison. At the present moment, the office REIT offer the highest yield at 11.4%. This in terms of average. And the retail REIT 6.7%, industrial REIT 6.3%, diversified REIT 6.2%, specialized REIT mainly more on the data center offering 5.4%, hospitality REIT 5.2%, and also healthcare REIT 4.8%. Do take note that the dividend yield show here, they are lagging data. All right, moving forward, it may increase or it may decrease in terms of dividend yield. But this is just give everyone a snapshot on what is the yield for a different sector now. Okay, if you look at the 10 years price to book by sector, okay, in general, we always use a price to NAV, PNAV as a valuation. Anything above 1, which means it's overvalued. Anything below 1 is undervalued. This one in general. So if you look across the whole sector, diversified, healthcare, hospitality, industrial, office, retail, you can see some very interesting finding. Office REIT at the present moment, if you look at the historical price to book itself, they are trading at the lowest end. Okay, so at the present moment, there are a lot of fear in the commercial office sector, especially in US, to bring the whole valuation down. Okay, and the valuation is pretty low. 0.5. Okay, what does a 0.5 means? Okay, when a 0.5 here means that if your property value worth 1 million, at the present moment they are only traded at 500,000. So you just need to spend 500,000. You can go and buy the 1 million worth of property, and you can see from here the US commercial office at the present moment, the price to book low, even lower than 0.5. Some of them 0.2, 0.3. Okay, which means that there are a lot of good opportunity out there to buy some of the distressed REIT at a huge discount. Okay, beside the commercial office, and you can see that actually diversified REIT basically comprises of a combination of retail mall and also the commercial office. Because commercial office also affected, that's why you can also bring down the whole diversified sector. You can see that actually they are also trading at the lower end of the price to book. Hospitality is on the way out. You can see that they are not trading at the lower end. They are on the way out, but they still have not fully recovered yet. There are still a lot of upside moving forward before they can hit the historical high due to the reopening of the border, reopening of the economy. Industrial sector itself is also muted. Okay, one thing for sure is they are not trading at a high. They are just either traded below the price to book or at the average range. Okay, And the retail in Singapore itself still have not really fully recovered, have not really chased as high as the hospitality, because at the present moment, the China tourists still have not really fully back in Singapore yet. Okay, so in short, all in all, that overall the Singapore REIT sector, be it any sector at the present moment, is undervalued at the moment. Okay, now we look at the interest rate movement, how the interest rate movement can affect each sector. Okay, first thing first, that if you look at the past 20 years US interest rate, at the present moment, we are at 5.5%. And if you compare to the past 20 years, 5.5% is almost at the 20 years high. And eventually, interest rate has to come down. It cannot continue to go up together at the present moment, right? Because a lot of things you crack, okay? But just disclaimer first, if the interest rate continue to go up, the REIT market in Singapore will continue to go bearish, okay? Will not recover. But at the present moment, it is a very high probability interest rate will be going sideways for a while. If you look back at 2007, 2008, and 2009, you probably will follow the pattern over here, hitting the peak, moving sideways for a while before start coming down. And when the interest rate start coming down, they will be very steep. So as an investor, we need to anticipate what would be the interest rate movement moving forward, because at the present moment, the Singapore REIT bearishness is largely due to the interest rate, because the rate hike just too fast, too furious, and cause a lot of damage into the Singapore REIT itself. But eventually, if the interest rate start to come down, that will give a relief and also catalyst to the REIT sector. And if you look at the US interest rate dot plot by the FOMC committee members, it is expected, okay, this is 2023. 2023, you can see that majority have a consensus that interest rate will be around this level, which is 5.5%. Okay, and moving into the 2024, majority consensus would be from 5.5% drop to 4.5% in 2024. And after that, the interest rate is expected to continue to come down in 2025. So based on the dot plot, and also based on the current interest rate, and it's quite a high probability interest rate will start to taper down moving into 2024. Now the next one I will show you, this is the probability, meeting probability of the interest rate hike based on the interest rate futures traded by all the traders. Okay, how to read this chart and table. So this is the meeting date by the FOMC. Every meeting, they will make a decision on what would be the rate hike or rate cut, or they want to hold interest rate. And on this x-axis itself, basically is a band of interest rate. So at the present moment, we are at this range, 5.25% to 5.5%. So on 20th of September, 88.5% of probability they will hold the rate. They will not have any rate hike. There's only 11.5% they will increase the rate and by another 25 basis points. So majority of them, they'll still hold the rate at this level. You can see that they will hold the rate until first quarter of 2024. Okay, first quarter in 2024, and after that, the rate will start to drop sharply. Okay, by end of 2024, okay, that means the rate you drop from 5.5% to 4.25%, which is a 1.25% cut. Okay, this is quite a drastic cut also. So as an investor, we need to anticipate what would be the interest rate moving forward, and we need to start positioning our investment. If the REIT at the present moment is being sold down and also selling a huge discount, when the interest rate start to drop, definitely there will be some sector rotation or different asset class go back to REIT again. Because you just imagine when the rate start to cut, that means the T-bill, the bank interest rate will start to drop. In order to continue to have that kind of return, the investor or big institution or fund manager, they're trying to look for different asset class which can yield higher than bank interest rate to move their money into their asset class. So REIT being one of the asset class will benefit from this rate cut. So beside that, some of the balance sheet, cash flow, and also covenant you'll be impacted by the interest rate. I'm not going through all the detail here because this one I need to spend 2 days to really go through all the financial ratio and what is the impact and how this one can affect the balance sheet. So in short, just a summary. The interest rate, whether when you're going out or coming down, you have an impact on the asset valuation because the asset valuation largely determined by the cap rate. Cap rate is also affected by the interest rate, and also when the asset valuation start to drop, the gearing ratio will start to increase, and at some point that will breach the gearing limit of 50% in Singapore. And when your asset value drop, you affect your net asset value. When the net asset value being affected, your share price will be affected. So they are all interlinked. Beside the balance sheet itself, you also see that actually REIT you'll be affected by the interest rate impact and on the cash flow. So if you pay attention to the most recent earning release for most of the REIT in Singapore, about 60% of them actually they announced a cut in DPO year over year. And one of the very common reason the REIT manager bring up is because their interest expense of their debt is increasing. This is the cost of debt. When the cost of debt increase, there will impact on reduce the net property income and eventually will affect the DPO payout. Okay, at the same time, when they have a higher interest expense, the interest coverage ratio also coming down. This one is to measure the liquidity of the REIT itself. And all these things will also impact to those creditors because there are some covenant the REIT have to meet or fulfill in order to extend their loan. So the secure and unsecured borrowing ratio is starting to come in. The credit rating of the REIT is starting to come in this high interest rate environment. All these things previously was not an issue. It's only thing that recently, because the high interest rate caused some REIT have some debt management issue, their balance sheet being damaged. That's why all these things you start to appear. So investors have to pay attention to those financial ratio. If you do not understand the financial ratio, but you still want to invest in REIT, I would strongly suggest you go and do a read up on all those financial ratio, because the financial ratio will give you some insight whether the REIT has any problem or don't have any problem moving forward. So next, I move on to the Singapore REIT sector. Typically, there are 5 general REIT sector in Singapore. 5 at the present moment, the main one. Okay, we have a commercial office which will focus on a office building. We have the industrial sector focusing on the warehouse, logistics, factories, port, and we have the retail mall sector. We have a healthcare sector. Those REIT invest in hospital, nursing home. And we also have a hospitality sector whereby the REIT hold the hotel and also service residents. So there is another subsector coming out. Okay, data center. Data center previously was categorized under the industrial, but recently data center is considered the new economy. Investor, you can classify it as the industrial sector also. At the same time, you also can pull it up to classify under the specialized REIT sector. Okay, and student accommodation is still being considered under the hospitality sector. Okay, now there's also under SGX classification, there's another sector coming out because there are quite a number of REIT, for example, CICD, Capital Land Integrated Commercial Trust. They combine, they merge the mall and also commercial office together. So when they merge the mall and commercial office together, you can't really differentiate whether it's an office REIT or is a retail REIT. So they come out another classification called diversified REIT sector. So as long as there are some of the combination of different sector, everything to be classified as a diversified REIT. Okay, some of the example. Okay, VivoCity owned by Mapletree Pan Asia Commercial Trust, and Airlock Commodity Hub. If you stay in the west, probably you have seen this building before. It's under ESR logos. Okay, these are under the industrial sector, and office sector will be the Suntec City, and hospitality sector you have a ARA US Hospitality Trust. They own the brand Hyatt Place in Oklahoma, US, And healthcare sector, you can see that actually Mount E Hospital in Singapore actually owned by the Parkway Life. So I quickly go through what are the retail sector is quite straightforward. So retail sector basically is just focus on retail mall. So these are the list of the retail mall in Singapore and also overseas. For example, BHG Retail REIT, they have 100% property or retail mall in China. Fraser Center Point, 100% Singapore. Lippo Mall Industrial Retail REIT, 100% in Indonesia. Cesio is the outlet in China. Paragon have the Paragon Medical Center and also Clementi Mall and some of the Australia retail. And Star Hill Global, Ngee City, the Wisma Atria is under the Star Hill Global. United Hemisphere, this is a grocery retail mall in US. So you can see that actually the mall also have a different region exposure. Okay, there are a lot of financial number over here. Just like I mentioned some of the financial number. Okay, you can see the whole sector as a whole. At the present moment, year to date, the retail sector, the best two performer are the Fraser Center Point and also Paragon REIT. Okay, so you don't see a significant, very obvious that kind of sector rotation in the retail. Basically, the performance is mixed. Okay, but if you look at the valuation itself, the valuation 5 years, the price to book, they are not very expensive. Some of them are traded at the historical low, and quite a number of them just the halfway mark. And interest coverage ratio itself, this one is based on the liquidity itself. Some of them have some problem, especially those REIT overseas. For example, BHG in China and also the Lippo Mall in Indonesia. So those REIT have a Singapore exposure actually are doing better. Office REIT, okay, as the name implies, they invest in a commercial office. So these are the list of office. Okay, Elite Commercial REIT, they are having the property in UK, 100%. ARIA Global, you'll be in Europe, some of them in Germany and Spain. And Capital REIT, majority of them in Singapore. They have some property in Australia. Capital Pacific Oak US REIT have a commercial office in US. Manulife US REIT in US. Prime US REIT in US. Okay, so this sector is the sector which is totally out of rotation. Okay, the REIT itself, the valuation dropped a lot due to the high interest rate, high cap rate in the valuation. At the same time, the work from home trend actually is still happening in US. Then the employee actually quite slow to returning to the office, although it's getting better and better, more and more people go back to the office, but it's pretty slow. So the occupancy rate in the US commercial office itself is still pretty high, and coupled with the high cap rate used in the valuation, there is a huge drop in terms of the US office valuation. Okay, and all these things create the ripple effect to the whole REIT sector itself, whole commercial REIT sector itself. So ARIA Global also being affected, Elite Commercial REIT in terms of valuation also affected. Okay, except the commercial office in Singapore. Capital REIT is pretty resilient. There's no drop in the price to book. So if you ask me what is the strongest REIT in the commercial office sector, will be the Capital REIT. Okay, you can see from here that the PNAV itself, Capital REIT, although traded at the lower end, but they are not as low as compared to the rest of the REIT. They are really traded at a historical low. Okay, Capital Pacific US REIT, Manulife US REIT, Elite Commercial REIT, Prime US REIT, they are historical low. Okay, what does it mean? If those REIT, they are able to withstand the current valuation issue, the current gearing issue, you can see that actually gearing is pretty high, and their Manulife has already breached a gearing limit of 50%. If they are able to come to withstand the current shock itself, and when the whole market recover itself, all these REIT you present the greatest opportunity, because at the present moment, if you look at the price to book, the price to book is very undervalued. Look at Manulife 0.16. What does it mean? The property worth 1 million, you only need to pay 160,000 to own the grade A office for Manulife. Okay, elite commercial rate 600,000 to own $1 million. Prime US rate 240,000 just to own the 1 million worth of property. So at the present moment, this sector is totally undervalued. Okay, a lot of risk there, and if they are able to recover, able to withstand, okay, this sector will present the largest upside potential moving forward. Okay, but to take note that you have to do your homework carefully. All right, if you look at all the ratio itself, most of the ratio looks healthy. Most of the ratio looks healthy. It's only thing that valuation having a big problem. So this US commercial office, the valuation is a big issue now. Okay, so industrial sector have these are the property: general industrial building, high-tech industrial building, business park, warehouse and logistics, and data center. Around the whole Singapore itself, you can see that actually there are many industrial REIT in Singapore. You just pay attention, you should be able to find them whenever you go out, right? For example, Benjamin Road, the high-tech industrial, Airlock Commodity Hub, Maple Tree Business City. This is a business park. Okay, and also you have the data center. Probably you have seen this kind of building before if you stay nearby, and also you have a flatted factory. So these are the list of the industrial REIT. You have AIMS APAC, majority of the property in Singapore and Australia. CapitaLand Ascender Street, EC World in China, E-Logistic, and also Port in China. ESR Logos, they have property in Singapore and also Australia. Now they are also planning to diversify into Japan or logistics. Maple Tree Industrial, around 50% of the those business park, high-tech building, and another 50% actually is from a data center. Maple Tree Logistics is very diversified across the whole region. Savannah many industrial building in Singapore. Okay, so if you look at the whole industrial sector itself, the ratio looks healthy. You don't have see any shock. If you look at gearing, if you compare to the commercial office itself, the industrial sector looks pretty healthy. Okay, most of them are below 40, and the lease expiry is also pretty long. Majority of them, the interest cover ratio looks very healthy. So industrial sector at the present moment, of course, you don't see a big rally now, but so far the industrial sector has been the most resilient. So when the economy start to recover, or the sector rotation back to the REIT itself, okay, you can take a look into the industrial sector. Hospitality sector, okay. In short, hospitality sector, they are having those hotel, service resident, or even some of them resort. Okay, so this is a Maldives resort owned by CDL Hospitality Trust, and these are the list of a hospitality trust in Singapore. You have a ARA US Hospitality Trust. They are having the US Hotel, Escort Resident Trust. They have a hotel globally and also service resident globally. CDL Hospitality Trust, you have some hotel in Singapore and the rest in other places. Eagle Hospitality Trust are suspended. Okay, they used to own the US hotel, and most likely this REIT will be delisted because they have already bankrupt. Okay, so investors also need to pay attention during this high interest rate environment. Some REIT, if they are not able to service their debt, they also may go bankrupt. And 100% play would be from the Far East Hospitality Trust and also Fraser Hospitality Trust. They have some of the asset over other countries. Okay, so in terms of the hospitality sector itself, this sector actually is on the way to recovering. Okay, it's still not fully recovered yet. It's still on the halfway, and some of the financial ratio, it looks healthy. Of course, the spread does not looks attractive because they still have not really recovered fully on the occupancy. When they continue to recover fully to an occupancy rate and fill out all the hotel room itself, the DPU will start to come back. Healthcare, there are only two healthcare REIT in Singapore, First REIT and also Parkway Life. The result is pretty mixed. Parkway Life is the most resilient REIT, but at the same time, Parkway Life also is the most expensive REIT because they are always traded at a premium. First REIT, you look at all the financial ratio itself, that looks attractive, but First REIT was beaten down very badly last time due to the sponsor issue. Okay, now have the list of diversified REIT. We have a Fraser Logistic and Commercial Trust, Cromwell European REIT, Mapletree Pan Asia, okay, and so on and so forth. I'm not going to repeat everything here. Just want to give a glance what would this diversified sector performance. Okay, if you look at the gearing ratio itself, there are quite a number of them is on the high side in terms of gearing. Okay, it's not surprisingly because the commercial office valuation dropped quite a bit, especially for those overseas property itself. So it's also affected into this the commercial office side. Okay, beside that, the DPU is not really fantastic, and you can look at the price to book itself. Most of them, all of them actually traded below the book value. Okay, so if you know how to do a proper selection itself, definitely there are a lot of gem out there. The REIT with strong fundamental and also traded at a huge discount is good for the investor to do some study and also pick up some good REIT out there. Okay, Singapore REIT sector performance and valuation. Okay, I want to talk about the property clock in Singapore. This property clock issued by DBS. Okay, in short, at the present moment, the retail and also hotel is on the rising market. Okay, this is not surprise because of the border reopening and also the airline industrial, the travel industrial start to recover. So over the long term, it is expected hotel and retail sector will be continuing to do well. Industrial still continue to do well and also is quite resilient. Okay, office especially in the Singapore side is picking because office the rental has already increased very fast for the past 1 or 2 years. Okay, this one is purely more on the Singapore side, but on the US side is quite mixed. Some of them on the falling, some of them are bottoming, so we cannot conclude on the US side. If you want to look at the US side property clock, you can take a look into those financial report or the quarterly earnings issued by Manulife US REIT, Prime US REIT, or Capital Pacific REIT. They will show the different market for the different country or different city in US. Okay, I talk about this one. So in short, okay, I just summarize what I say into this table. Okay, there are always a sector rotation within the REIT itself. Okay, if you can recall in 2020 when we have the COVID crash and also everyone being locked down at home, at that time the travel related, the kind of industry or travel related or hospitality sector related REIT, they are impacted very badly. So we see the share price plunge in the hospitality sector. So these are the weak sector in 2020. And a strong sector that year, actually from the big cap industrial REIT, for example, Ascenders REIT, Mapletree Industrial Trust, Mapletree Logistics Trust, those are the big cap industrial, right? And at the same time, the data center, capital data center actually doing pretty well at that point of time. In 2021, there's no strong sector. Basically, the REIT sector is moving sideways, and hospitality sector continue to be weak. Okay, 2022 we see the recovery in the hospitality sector, but at the same time we also see the decline of the US commercial office sector. Okay, so based on all these things itself, right, you can see that whatever goes down, you come up eventually, right? Actually, in 2022, I forget to put in here the sector which performed very badly, also data center. Okay, 2022, data center is also the weak sector. But when it comes to 2023, data centers start to come back up. If you look at the chart itself, Capital Data Center REIT actually is on an uptrend. So Capital Data Center is pretty strong REIT for this year. So we can see that that there's always a rotation in the REIT itself. Now, as an investor, we need to plan for next step. All right. So if you are looking for a very stable that kind of dividend portfolio, of course you can consider those industrial sector. But if you want to aim for a huge capital gain, okay, and if you believe US will recover, US commercial office will recover eventually, you can start to do some stock picking or some of the overseas commercial sector. You can do some homework over there. Okay, so next I will go with the investing tips for the second half 2023 and beyond. This is the US interest rate hike I have shown you just now. Okay, I highlight those boxes over here. Okay, this mark in red color, red boxes, and red boxes. Okay, basically, I just want to show during this period, the interest rate start to come down. Okay, as an investor, we have to start to plan what would happen to the REIT sector when the interest rate start to come down and stay low for a while. Okay, so this period, interest rates start to come down, stay low, and after that start to rise again, come down, stay low, start to rise again, come down, stay low, start to rise again. Okay, I will show you the correlation with the asset class performance. This is the 20 years performance for different asset class. Okay, a bit busy here. I'll go slow with this one. So on the right hand side, you can see the annualized return for the past 20 years. In average, every year, this large cap growth sector will give you 10.76%, right? In average, small cap is on the number 2 position and REIT on the number 3 position. 8.9% annualized return. This is a total return. That means the capital appreciation plus the dividend payout. This one is based on the FTSE REIT or REIT index. Okay, at the present moment, the whole REIT, the global REIT is underperformed, right? Because the high interest rate is not only Singapore REIT sector, US REIT sector is also performing quite badly. Okay, now I go back to this one. The interest rate start to come down in 2003. Okay, you can see from 2003 over here, when the interest rate start to come down, the REIT will start to perform, outperform. In 2003, REIT annualized that year annual return is 38.47%. Okay, and then after that, the interest rate stay low for a while. 2004, 30.4%. 2005, 8.29%. Right, 2006, 34%. Okay, when interest rate hit the peak, that's why you can see that actually the REIT itself negative 17%, negative 34%. Then after that, interest rate come down again in 2009 to 2017. Basically, is a positive year. You can see that double digit, 27%, 27%, 7%, 20% is fantastic performance. Then when it comes to 2009, okay, interest rates start to come down again. You also can see that positive return for a REIT, 28%, 39%. Now, we have a negative year in 2002, minus 25%. And probably we will also have some slight negative in 2003, right? We still have not ended the year yet. If you believe the history does repeat by itself, every time when there is a very negative year for the REIT itself, the subsequent year there will have a very, very positive year for the next few years. All right. If you believe in this cycle, okay, so you can make your own decision. Okay, when is a good time to go in? Okay, to start to build out your REIT portfolio. Okay, if the interest rates does start to come down in 2024, hopefully we can have this kind of performance minimum 3 to 4 years. For the REIT sector moving forward. Okay, beside that, if we look at the whole price to NAV for the whole FTSE REIT index itself, at the present moment is at 0.79. Okay, and this 0.79 even lower than the previous COVID crash. of PNAV of 0.8. But the current situation is very different from the previous situation. During the COVID lockdown itself, the whole world economy being stalled, and also the travel industry, everything is not moving because everything is locked down, and we are at a more or less we were at a dire state during that time. The price to book is only 0.8, but at the present moment, the price to book is 0.79, even lower than the previous COVID time. So if you're just purely looking at a chart itself and also looking at valuation itself, at the present moment, the whole S3 sector is pretty attractive. Okay, so it's important for the investor to really understand all the financial ratio here, because you can see some of the yield over here. Prime US REIT, they are trading around 30% yield, Manulife 20% yield. The yield is pretty attractive, but just to take note that all these are lagging data. Okay, definitely there are some rotten apple over there, but if you know how to identify those good REIT, probably there is a very good opportunity for you to double money in a very short period of time. So I have shared quite a number of those data from a screener itself. If you want to access the screener over here, right, you can scan this QR code, right, so that you can have access to those screener. Okay, it'll help in your analysis, and also do the screening of the REIT that you would prefer. Okay, after you have done all homework, doing a proper selection, understand all the financial ratio in detail itself, what you can do is you can diversify your portfolio into a different sector. You know that the sector you're going through the rotation, unless you are very skillful in trading the sector. Otherwise, I think I would strongly recommend you build a diversified portfolio, because one sector go up, the other portfolio you'll come down, and all in all you'll be even out eventually. So what you can do is every sector you select the top three, right? Top three for each sector. You have the top three for retail, top three of office, top three of industrial, top three of hospitality, top three of healthcare, and you just need to wait for the right entry point by looking at the valuation and looking at the chart, right? At the present moment, if you are able to build up the diversified REIT portfolio itself, it is quite easy for you to get a weighted average yield of 6.335. This is just based on the allocation for each sector, and based on the yield for each tax sector for itself. Okay, so key takeaway, I summarize it. At the present moment, the whole Singapore REIT is quite attractive based on the price to book, and interest rate has probably peaked in Q3 2023, and also will be coming down in 2024. That will give a huge relief to the REIT itself, because the cost of debt will be coming down. When the cost of debt coming down, that will help to boost the DPU. When it boosts the DPU itself, the share price will continue to follow accordingly. Okay, and S-REIT index may have found a bottom in October 2022 based on the chart itself. So it's very important to select the REIT with strong fundamental, because not all the REIT are good at the present moment. There are some of the REIT, the balance sheet has already damaged. You need to make sure in the selection itself, those REIT they are able to really come up stronger after this uncertain period of time. Okay, if you want to learn more, I have the SGX Academy REIT course in the coming month, September 16 and 23. Is a 2-day course. It's very comprehensive. That kind of REIT course is 2 full day interactive, the virtual training. And if you are eligible, there's up to 70% of a cost fee funding support from IBF. So if you're interested, you can scan a QR code over here. And what will be covered in this course itself? Okay, basically I will explain in detail how the REIT work, and what is their business model, and what the sector, and also I'll go through all the financial ratio, how to choose a REIT to invest, and how the external event and news affect the REIT market. I'll also going through some of the technical analysis to help you to time the entry better, and And also I teach you some of the little tactic how to further increase your return, okay, or reduce your investment risk. Okay, those are the practical section, because at the present moment I'm managing the REIT portfolio for my client. Okay, whatever thing I'm currently doing now, I also teach my student in the course. So if you want to find out more, this is the QR code you can scan, and you will be directed to the SGX Academy website, and you can check out all the detail there. All right. So if you want to contact me, this is my contact number, contact email, and if you want to talk to me, you can use a calendar and book your schedule, and you can talk to me with the REIT advisory, REIT portfolio management, investment planning, retirement planning, insurance portfolio audit, estate or legacy planning. All right. So I will stop my presentation here. Then I will look at if there's any question, I will answer those questions.
Hey Kenny, we have quite a few questions. Let me just upgrade you to an organizer, so you should be able to see all the questions.
Okay.
We have some very, very good questions, which I think the members of the audience will be keen to hear about. Okay, so I'm just upgrading you. Just give a few seconds. Okay, you should have an upgraded control panel now, and you should see the questions in the control panel. Just so you, if it's difficult for you to read, okay, just want to share that you can extract the control panel and enlarge it if it's easier to read. If not, I can read it out for you. Very happy to.
Let me see. Maybe you asked me a question because I can't see in the control panel. I saw a question. Okay, I saw it. I maximize it already.
Yeah. So yeah, we have this first question. Can you comment on the commercial real estate situation in the US? Will this trigger massive devaluation across the various REITs?
Okay, the massive devaluation has already occurred. All right. So I just attended the Manulife briefing yesterday, and two reasons why they have a massive devaluation. One is the valuer, they are using the very high terminal rate in view of the current risk in the US commercial office in US. So there is an inverse relationship in terms of the cap rate used and also the valuation used. When you have a very high cap rate as the denominator, your valuation drop. That's one factor. The other factor is the occupancy rate actually is dropping because due to the uncertainty in the US sector itself, because those employers, we just imagine the employer is so uncertain that whether the employee will coming back to office or not. So whenever they renew the lease, they will tend to renew a shorter lease. They dare not commit such a long lease. So the sentiment is pretty cautious in US. So all these things actually for the valuer itself, they're actually putting in the worst case scenario. Okay, at the present moment. And moving forward, if the interest rate start to peak and also hold for a while and start to come down, there is a possibility that this devaluation will stop. The massive, you stop here, you'll be flat for a while. All right. So there may be a bottoming out in the US commercial office, but we need another 2 more quarter of data to see. Okay, because they also show the data, actually the leasing activity start to pick up again, and also the occupancy rate start to pick up a little bit again. So there are some of the good news in the US commercial office, but we need more data point to really confirm that it's a turnaround. Okay.
All right, thank you, Kenny. Yeah, next question is about, there's some talk in the market about Manulife REITs. There's concerns that it could fall since prices have dropped quite a bit. What are your thoughts on it? Maybe you can provide us with better insights.
Okay, so the Manulife issue, if you look at all the financial ratio, the lease, and all the debt itself, they are they are okay. They are okay. The only problem they are facing now is the huge drop in terms of valuation and cause the gearing to shoot out to exceed the 50% gearing limit. So in order for them to meet the gearing limit again, they have to reduce their debt liability. Right. So at the present moment, in order to reduce the liability, they have to figure a way out. They have not given any answer yet. They have to figure the key objective. They have to improve liquidity. That's why they also stop a dividend payout. Okay, because they are also not sure that where the money come from, because they also do not want to raise additional money or raise the additional right to really fund those debt, because that will further dampen the investor sentiment and also devalue the REIT itself because the dilution. So what they want to do is they want to pay down the debt as much as possible. That's why they hold back, they stop a dividend payout. And at the same time, they hope the sponsor to come in to help them and also sell some property back to the sponsor again, right? Because at the present moment, the sentiment is so bad in the US commercial office, you don't panic sell the property, because when you panic sell the property, you realize the loss immediately. Because at the end of the day, this is just a number game. The valuation based on the assumption of what is the cap rate used, what is the occupancy rate used. The building, the Class A building is still there. It's still at a good location. You just need to wait for the whole sentiment to recover. So we do not know. We do not know what will happen now. Is quite bad for Manulife, and they just need to do one thing at a time. So far, no answer yet. We are still waiting for Manulife to see what's the next step. Okay, what would be the worst case scenario? Worst case scenario, they will prioritize because it's so cheap. The Manulife sponsor, this is just a personal opinion. They may prioritize, they buy back the REIT, and after that, they just call it a day. But they will have a reputation damage on the Manulife itself. On the other probable scenario is they will issue additional right to solve their gearing issue, but issue additional right at the current very low share price also does not really make sense. So the very high probability they'll go and sell some of the property away and also restructure the portfolio and hope to make a comeback.
Thank you for your insights, Kenny. Next question is, in your opinion, which sector REITs is best in case for interest rate? It is best in the scenario where interest rate remains high for a longer period.
No, because all the REIT itself, they will be impacted by the interest rate because of the debt. So it's not really sector specific, it's more REIT specific. As long as those REIT which were very high gearing, very low gearing ratio, and also have very high interest coverage ratio, they will be more resilient during this current environment. So pay attention to those debt management, especially on gearing, ICR, and also the debt profile. So there will not be any sector specific.
We have a very interesting question here from Han. Han is asking, can you share your view on REITs that have properties outside Singapore? Is it really worth investing? And what about those in China and the US?
Okay, it depends on the investor risk profile. When you move out of Singapore, you will be subjected to forex risk. Okay, just take note that everything they buy in overseas. For example, when you buy in US, you buy in US dollar, you collect your rental in US dollar, you pay your debt in US dollar. If you for example, I use Lipo Mall as an example. That is a negative example, but you understand what I mean. For Lipo Mall, the dividend payout and the share traded is in Sing dollar. But Lipo Mall having the property in Indonesia, they are collecting in Indonesia rupiah. So when the Sing dollar become very strong, definitely your dividend you'll be affected. So there is a forex risk. That's one. Second thing would be the regulation risk, because especially for in China, REIT is still pretty new in China, and the government can change the policy to protect the local investor or to protect local property market. So there's a policy risk, right? Those things that we can't control. And the third one will be the economic risk. In Singapore, we can feel and we can see, we can sense how the economy is doing, right? When we come to reinvesting, but when you invest in other country, you do not know. You do not know how the economy are doing over there. You do not know whether the government is tightening the control or inviting the foreign investor. You do not know. There are a lot of uncertainty. So because of all that kind of uncertainty, when you invest in the overseas property itself, you need a higher yield to compensate the risk. That's why you can compare those REIT with 100% Singapore property, and also those REITs with a lot of exposure to the overseas property. You can see that those REIT with overseas exposure tends to have a higher yield. This is to compensate it. So there's no worth or not worth investing. It depends on whether you are able to take a risk, right? If you're able to take a risk itself, of course, that there's also the good capital appreciation when the market recover.
All right, this is the last question for you, Kenny. This is a very good one as well. REITs yields are about 6%, similar to corporate bonds for duration of 5 to 10 years. In this scenario, they are still attractive. What are your thoughts? Ideally, with equity nature and yields that are not confirmed, yields should technically be higher, right?
Okay, at the present moment, the investment grade corporate bond it is pretty attractive. I agree, right? And moving forward, when the interest come down, your corporate bond price will go up because has an inverse relationship. So when you invest in corporate bond, your coupon is fixed. Okay, and also your capital gain, because when the interest come down, is not as high as the REIT itself, because REIT being equity, they still have growth in terms of share price and also in terms of all those earnings and also the dividend. So it depends on which angle you are looking at. So in short answer is yes, at the present moment, yield is attractive. But on another hand, Singapore REIT at the present moment, due to the undervaluation itself, you are able to lock in high yield and also at a low price. When the market recover, beside the 6% yield you are getting, you still have the capital appreciation potential.
All right, thank you so much, Kenny, for your time today. And thank you for all your valuable insights. Personally, I'll be tuning into this webinar once more just to refresh on the insights you shared today. Members of the audience, I encourage you to do the same as well. And thank you for being part of today's webinar. Till our next webinar, take care and all the best. We are
Okay, thank you. Bye-bye.
Good night. Take care.